Good morning. We meet once again. Today is 25 November 2024 and the last week of November. We're going to start December and the end of the year soon. And we all know that Nour, usually December is, let's say it's a negative month for most of the stocks. And we've been seeing a lot of geopolitical tension at the same time. So there are a lot of subjects to discuss. Let's start with the geopolitical tension. We know that Putin tried his ballistic missile, and this is a threat for not just Ukraine, for all the countries around it and all the countries supporting Ukraine at the same
Mhm.
time. In parallel, this is something, of course, this is negative, positive for the gold and whatever's happening because the tension is increasing. From the other hand, in Lebanon, we've seen that Israel said that they agree to a principal ceasefire in Lebanon. So this is something positive for the geopolitical tension. It's less tension and negative for the gold. The market opened on a gap on most of the currencies. We've seen that the dollar index is correcting at the moment, and all of that to summarize that this week we're bouncing back from all the levels that we've seen last week. Is this move going to continue? The dollar index is going to continue weakening like that. And what do we do with the stocks? Let's take it step by step.
Let's start with gold and the dollar first. Gold, basically, after 5 days of consecutive gains, and this was basically fueled after, the retracement that we saw in gold, and fueled by the geopolitical tensions, especially the one, now it's becoming evident that, the U.S. is basically, or Ukraine is using new weapons, including from the U.S., France, and also the U.K. And Russia is basically told everybody that they are reserving the right to respond on these. So that's why basically gold showed a notable rally, 5 days of consecutive gains. And if you look at the weekly chart, this is basically a clear bullish engulfing candle, which usually is a continuing candle, meaning that the upside might actually continue. That's from one side. The other side also, don't forget also that you have to keep an eye also on the monthly chart, which ends this week. And if you look at it, you will see basically another reversal on the monthly that we've seen also before. And this also could be another continuation. So in short, the idea of a change in the current bullish trend in gold is not here yet. We at least need to see a break below maybe 2,500 in order to say yes. Gold basically closed or finished its upside rally, or it broke its uptrend before it can even continue lower. So for the time being, I think with the geopolitical tensions is still on the rise, even after the talks about a possible ceasefire in Lebanon, there's still more room for gold. Now, the downside retracement that we're seeing now, I would still be interested to look into it as an opportunity, especially after the retracement or the retracement at the beginning of this week, as long as we keep on holding above the 2,600. And the idea of another record high is still there. There's a possibility of even reaching more than that. Maybe even the 3,000 is possible before the end of the year, if that conflict basically expanding. Otherwise, I think we will maybe still trade within the range. That's from one side. Dollar index, at the same time, we basically finally reached the top of the past 2 years range. Yes, on Friday it tried to break it, but at the end of the session, we closed once again below that resistance. So it is good to expect at least some sort of retracement to the downside when it comes to the dollar index, and this might be fueled by whatever data we're waiting. Especially that last week, there's one of the most important data. Everybody was talking about how good the jobless claims was, but if you look at the continuing claims, which is much more important than the jobless claims, continuing claims is now at the highest level since 2021, and this basically shows us more evidence that the labor market is basically cooling, which continues to fuel the idea that the Federal Reserve will continue to cut rates, at least in the next meeting or in December. So
We
that's at
agree
least
that
for the
it's
dollar
going to
index and
keep on
gold.
ranging in the next period. Yeah. So
Most
it's
likely, we're going to stay
range.
within the same range of the 2 years range. I would
Yeah.
say we should see at least a slight retracement from here before if a breakout is going to happen. I would say it most likely won't happen from here until we see some sort of a retracement first.
Okay, and how does that affect basically the currencies? Because let's talk in particular, let's say about the euro dollar, right?
Mhm.
Okay, we've seen euro dollar breaking a huge support, and that support, we've been waiting a long time to break it. There's a lot of orders below it. We've seen the spike down last week, and it's very expected, right? Because there's a lot of orders below that level. And
Yeah,
shockingly, or at least for the retail, from the questions that I received, is that we did not continue, at least for an extra 50, 80 pip on the top of whatever the level that we've reached,
true.
the 0.333 or 0.330. So
Yeah,
we did not continue from that level further from that, but we did a correction and we bounced back from that. Europe is not in the best place currently. I think
Mhm.
with the new tariffs, with all the things that will come next year, and the market is pricing these stuff, eventually it's affecting the euro in a negative way. Is this
Yeah.
going to continue? Are we going to see this parity, let's say, this year before the end of 2024?
Yep.
Because on the monthly chart, if we close below the 104.70,
All right.
104.50, that's very negative, and that's amazing for that's the second month that we are negative on historically. We've never reached these levels before.
Yeah. I mean, here's the thing about the euro. First of all, the major decline that we saw on Friday was basically fueled by the services PMI's data across Europe. And one of the main reasons, because over the past few months, the services sector was the one, or was the sector that showed a lot of stabilization, which helped the euro for a while. But at the same time now, we're starting to see a shrinking services sector, which will basically continues to support the ECB in its expectations or in its policy to cut rates even further. So that basically, or the numbers that we saw on Friday, this basically what fueled the downside pressure. At the same time, it was just only for a very short period of time where the euro went all the way to 103.80s before it basically recovered almost the entire move. And with today's gap, the entire move of Friday has been recovered. Now, if you on Friday, if you had a very high or risky risk management, this basically, I would say, most likely a lot of retail traders have been basically, they're stopped or they were stopped out. But at the same time, if you have like a very manageable risk management and very tough risk management, this basically will tell you that you did not you didn't
Talking
have
for the
the idea
buyers.
of panicking. Yes, and at the same time, and don't forget, we're in a 2 years range support, and breaking that level would not be easy. So I wasn't like shocked that the recovery happened
Okay.
fast. We've seen this before multiple times for the past 2 years. So it is hard for me to expect that the euro would continue going lower from here towards parity before we see at least some sort of retracement. That retracement might actually may take us also all the way to 108 or even 109. That is highly possible. Parity, everybody's talking about parity, and this is one thing that I don't like, that when everybody's on the same page in a very short period of time. So I would say parity is possible, but it might not be this
Not this
year.
year.
But as long as now, before it was the Federal Reserve who's basically supposed to cut rates faster in a larger pace. But on the other side now, things are changing. The ECB might be now the one who may need to cut rates faster, and the Fed might just basically take the time. This is what might actually lead the euro towards the parity, but we still need to see a little bit of a retracement, and it needs a little bit more time to confirm, especially that the services sector's data was just once or once after a stabilization. So that might be just only a short term or a very short term decline in the services sector.
Okay. Well, the possibility of the parity is still out there.
Yeah,
That's good. And if I'm gonna tell you about the retail flow, they did make money and it was good. The
that's
buyer
good.
did get stopped, as you said, of course, but it was a tiny stop because the major support was something that they all knew about. Like the whole market knew about the major support, and
Yep.
there were a lot of trades below the support to sell. So we've seen some good profits in the market. Okay, so if we want to move to a more important subject, let's say the oil, we've seen that we're continuing, or we broke the trend down
Mhm.
with US oil or even UK oil. We broke the trend down, and we're trading at the moment around $71 on the US oil. We just did a small correction or retracement of 70 cents until this level. But we're still trading within the moving averages. Maybe if
Yeah.
we break 72, we might head to 73 and 75 later on. But until this moment, the market's still kind of like working in a sideway after the trend up and after breaking that. What do you expect from the market? Although definitely OPEC or OPEC Plus, they've done an amazing job maintaining the price and all these stuff. But with the geopolitical tension and everything that's been happening, there's not much movement that we're seeing on oil.
Yeah, I'm going to be very brief about oil. OPEC Plus managed to made it clear basically that they like Brent above 70 or above 72. Each time we did test that 72, we get a verbal intervention. Verbal interventions that by through either they'll send out one of the delegates to talk about a possible delay in the production increase, or any other of the OPEC Plus countries would come out with some sort of a statement to support the prices. They managed to, or they succeeded in that. And I think anything between 72 and $70, will basically fuel any kind of intervention. That's from one side.
Right.
On the upside now, since we broke the trend to the upside, I think anything between 74 to 80 is considered a balanced price for consumers and for producers. So, but at the same time, I would expect, I would say, I would lean more towards the upside more than the downside, at least when it comes to geopolitical tensions from one side. OPEC Plus policy over the past few months also, despite the fact that they want to increase the production. Supposedly in January or December, but still anything between 72 and 70, I think this would be the new floor until any kind of new developments that would happen over the next few weeks.
Yeah, maybe next week as well, we're going to speak about natural gas and the demand that's going to increase in the next few months. But in the meantime, in 30 seconds, let's discuss what we mentioned, the US indices. US indices are at the highest high. Every time we're doing a new high. When we are at the top, it's very hard to buy, and it's not really recommendable to do that. And at the same time, when we do the correction, the retail flows start asking the same questions. Is the bubble getting bursted from the levels where we are at the moment? So there's a lot of back and forth regarding this subject.
Yeah.
Although the infrastructure of the US tells us that this is the right opportunity. In December, we mentioned it last week. Usually in December, indices, they back down, they correct, they do all these corrections or retracement in the market. Are we going to see the same thing from now till the end of December or end of the year? How can we grab the opportunity in your opinion?
I think, but for the time being, also, I'm going to be very brief about the US. Everything that is happening over the past few weeks is basically is not pricing in what Trump's going to do. Because if Trump decided to do whatever he's talking about, tariffs and stuff, that might not be actually fueling the stocks that much. That's from one side. Although it would increase at least, some sort of growth, if there will be no budget deficit, or there will be no spending cuts. That's from one side. At the same time, earnings were good. In general, earnings were good. At the same time, the guidance were a little bit they're very not tough, but they're not clear as they used to be. They're in a kind of in a moderate, let's say guidance. And as an example, Nvidia did not give the market what was needed. Despite that, I still believe it's hard for me to say the market would continue up forever from here. I would still be happy to see at least between 5 and 7% retracement. This is when I would consider basically buying. That's whether Nvidia or whether we're talking about S&P, Dow Jones, or Nasdaq. I would still prefer to go somewhere where the market is still basically much lower than where it was today, as an example for China. But in the time or for the time being, as we are at record high, it's not manageable for me to basically jump on or jump in. At this point, I would still be more than happy to see some sort of retracement. Maybe at the beginning of next year, I would say that would be a better maybe better timing to start positioning again, but I wouldn't be positioning at this time.
Let's see, we still have time. We're going to discuss this many times in the next few weeks. I want to tell everyone, remember, Wednesday we have the FOMC meeting minutes and the core PCE. And at the same time, happy Thanksgiving, and we'll see you next week.
Have a good week.